everyone? Welcome to the Hidden Edge Deep Dive Pod, episode 2. It is Sam, not with Kris, unfortunately, but it's all good. I'm going to take this time to kind of go over a little bit of some stocks that I got into, go a little bit over the macro and what my thoughts are in terms of the market and the future outlook. Like, where are we going to head? Where are we right now? Where's everything going? What's really the market telling us? So I really kind of want to start out with something that was pretty funny because a lot of people did talk about it and mention it to me afterwards on the last pod was these IT outages that has been happening. And it isn't really something that's been happening to just Kris, but it has happened to me a lot in the past. And I don't really experience it as much anymore. Someone connected me and they told me that it was really funny because they kind of experience the same thing in terms of the outages. You know, they get called in the middle of the night or something, or they have to work early or late hours to take care of some problems that some users are having. And then, before they know it, that's all they're doing all day. For me, it's not so much that happens. I don't know if you guys really know a lot about me, but I mean, I've been working in IT for about like 15 years now. Used to work in first level help desk, did a lot of that critical support where I got to do long 50 hours, 50 hours, 60 hours a week, did the overtime and everything. Now I'm like I'm more of like a software engineer and developer where I do more of the coding in the back end. So I don't really have to experience that much of that. Like someone's going to call me at like 5 a.m. to take care of something, and I'm going to be on the call with like support and vendor for like 12 hours or something. I don't really get that much anymore, but it has its perks, but at the same time, it has its downsides because I end up having to just drop everything I'm doing to kind of work on a project for, I don't know, like weeks on end. And I don't have time to look at the markets anymore. I don't have time to really focus anything. And on top of that, I mean, I'm not someone who is, I'm single or I have no kids or anything. Like I got 2 kids. I'm married. I got a house. My kids are going through private school right now, and that's not exactly the cheapest thing in the whole world. So like all of these things really add up, and it's something that I kind of took to my heart a little bit when I was talking to one of the Patreons recently. He was telling me I thought the whole time that maybe he was probably 30 years old. I didn't really get the sense that he had kids or anything, but you know he just graduated college and he's working for a startup company and he's doing pretty good and everything. But like this whole time I thought, and I've been talking to him for like a year now, and this whole time I thought, he was in my shoes, but he's not really. Like he's more in the younger, he's in a younger state, and he's got his whole life ahead of him. And what that really reflected on me was like, okay, well, it isn't as easy as it was in my early 20s, where I really had nothing else to worry about but myself. I had a lot of time in my hands. Time was like, time was in abundance. Now in my late 30s, time is not really like that anymore at all. I have to be very efficient with my time, and work isn't as demanding anymore, considering how much experience I have. But at the same time, I have to, turn the dial and focus on work and do what I got to do. And then at the same time, balance out the kids, balance out the stock market, balance out the Patreon that I got with you guys and Kris, pushing out some good content with the content creation. It's a lot. Like, I'm not going to lie. It's a lot. And the thing is that really holds it all together is that in terms of the market is that, you got to have that emergency fund, and you got to make sure that that high interest debt is really paid off. Because if that stuff really isn't paid off, like if you have like student loans, like 50, 100 grand, that's in like high interest, like the high single digits or even like low double digits. For some people, they might have that if they had no choice to take out a personal loan or anything. You might be screwed. And then you're going to be like looking at the markets and everything if you're invested, and you're going to be like hoping, maybe I can make like this big gain to kind of help pay this off, get rich quick scheme. And the way that I'm kind of working into this is that the way that I look at the markets right now is that we're up like 60, 70% since the bottom of 2022. I mean, the QQQs were at 250, 260 around that time, and now they're sitting over here around 500. So it nearly made 100% gain. And the question you got to kind of ask yourself is like, are you going to buy these overvalued assets? I'm not saying every single thing's overvalued, because some stuff, is pretty fair valued, and even I would say even undervalued for some of them, considering the future trajectory, which is what, I'm going to go over some of that today. But I wanted to start out with this by basically saying, like, is your personal life, and also is your personal situation handled where you can take on this additional risk in the markets? And if you're not someone who wants to take on risk, if you're not someone who wants to, invest in opportunity and throw in sums of money to be able to make a quick gain, probably in like 6 or 8 months, then it's probably better to just invest in the index funds, stay in the 401k, maybe dollar cost average into S&P 500. Maybe the Qs are feeling a little bit risky, and so on. But at the same time, if you're someone that wants to put in the time and the effort, like I just told you, I have a full-time job. I got 2 kids, family, kids are going to school and everything. Fortunately, I'm blessed that, I have a good job, healthy life and everything, praise God and everything. But at the same time, like, I don't have that thought running in the back of my head where it's like, I can't lose this money. If you're someone who it's like, if I need this money, and if I lose it, then that's it. It's gone. Then that's something that you might need to consider if you want to add the risk of being in the stock market. Because what you got to understand is the stock market is not a game. This is not a game. You can lose it all in one day if you don't properly manage your risk. So, I just want to kind of get that point across before I go over some stocks that I want to go over today. In addition, going further with my macro outlook, because the moves that I made recently have been pretty risky. So before I start off, man, what's up, Zo Cold? Dude, for some reason, like, I thought maybe you were someone who was like younger in their 20s, like no kids, no family and everything. But I mean, when you tell me that, I saw that in a recent pod, and I was just like, well, really, Zo? Like, you look like you're like in your mid 20s a little bit. I'm surprised, man. Props to you. Props to you. Like, it is not easy. It is not easy. But I guess the older you get, the better you get at time management. Because when you're younger, you don't really have that much worried about. What's going on? Hi, what's going on? Let's see. Oh, dude. Look at this image. Like, look at this image. Why is this guy in stocks? He should be like a supermodel in like Europe or something, man. What's going on? What's going on? Wong Investments, Big Billy, Don, Roge Rocket, Midwest. What is going on, man? Thank you, guys. God bless. Thank you for being on this late night podcast. Kris and I we were supposed to be on today, actually, but Kris had he had an IT outage he had to attend to. I mean, he was just talking about this last week, but I mean, it happens. You got priorities you got to attend to, and to be honest, like, if you got a full-time job, and that's pressing against you, you need to focus on that. The market is secondary, but of course, no matter what, though, family always comes first. If family makes its calling, someone sick in the family, you got to attend to that no matter what. Jesus, 3 kids. Oh, I only got 2 kids. I can't go that route. That'd be a little crazy for me. But anyways, that was the intro I wanted to get into, and I'm very glad again for you guys to join me on the Hidden Edge Pod Deep Dive episode 2. A lot of these are going to be more solo, focusing on like particular stocks. Maybe Kris and I, we might come on here. We might talk about specific stocks, specific companies. And then we also got the third degree where we bring on another member that could be a part of the Patreon contributor. And we're actually hoping to have one of the familiar faces that are on the Discord with us on the next one. We're hoping to do next week, but we'll see. There's a little bit of scheduling conflict because he is located in Europe. So the time difference kind of makes it a little bit difficult, but we'll try to work things out to bring you guys some good content. All right. So let's start out with the macro content. Now, I don't know how to really say this, but I'm a little confused at the dynamic of the markets right now. And it's not so much, like I've been like someone who's been thinking we're in meltup mode ever since the Fed was getting into the rate cut scenario last September. I mean, the market was already priced in the rate cut, but it was kind of surprising because everyone was thinking there's going to be 25 basis points. And it's been that way for a while, especially in August. There was like a minute where the market was thinking, like it was like around August 5th, when the Japanese yen carry trade kind of wound a little bit and then kind of bounced back and everything. And it's funny because, for a minute, the yen was like down to the levels where it was during August 5th, but the market was clearly not in that level. But there was a time when people thought that there was going to be an emergency rate cut. And I stood my ground. I didn't think there was going to be an emergency rate cut. I always stood my ground and thought it's going to be 25 basis points September. And then out of nowhere, and we're kind of going back in time a little bit to just kind of rewind and figure out where we are today. But in order to figure out where we are today, we got to remember what happened in the past. But yeah, a week before the meeting, the Friday before the meeting to be specific, Nick Taramos and of the Wall Street Journal, as well as another journalist, came out and they basically came out and said that the Fed is going to do a 50 basis points hike, and the reasons for it, of course. And the market just immediately priced in to a 50 basis points hike. And one thing you guys got to remember with the Fed is that they don't want to surprise the market. All right. They don't want to shock the markets, because if you shock the markets, you're going to cause a lot of volatility and you're going to cause a lot of panic. It may not seem that way in the immediate scenario, but at the same time, the Fed does not want to shock the markets. If the market gives them 50 basis points, they're going to do 50 basis points, or they're going to figure out some way to do 50 basis points. The last time we had an emergency rate cut was like, geez, I don't know. Off the top of my head, I'm thinking like Volcker maybe. In the inflation, when inflation got a little bit crazy in the 1970s or early 1980s, they did the emergency hike. I don't know, emergency rate cut. I think, the emergency rate cut, of course, happened during COVID, where they set rates to zero. And yeah, that was on a Sunday night, now that I remember it. But to do that recently and to do that now, like, very unlikely that's going to happen. I mean, the Fed does say that they're going to remain data dependent. But at the same time, they're kind of stepping ahead of their original plan of waiting till inflation is completely defeated. But now it's less of like, let's wait until inflation is completely defeated, where it's like around the low 2%. And now they're just like, well, we're going to get around 2%. So we're going to we think we defeated inflation. So we're going to go ahead and cut rates 50 basis points. So that's what happened. Now, what is happening today? Let's take a look at some charts. Let's get down and dirty over here. All right. Let me bring up the charts. I use TradingView, and it's actually really funny because Wong Investments was just talking about how TradingView is charging like $200 a month, $200 a year. And to be completely honest, TradingView is not freaking cheap, dude. TradingView is expensive. And, at the same time, like, there's really nothing else that compares to TradingView at all. Like, this is a really good platform. We'll see how Robinhood turns out. But at the end of the day, I really do think TradingView is the number one platform when it comes to charting and everything. So, we got the SPY ETF, the S&P 500 ETF. What I wanted to take a look at was the weekly RSI. So right now we are at 74 on a scale from 0 to 100 in terms of the weekly RSI for SPY. That is in an overbought territory on the 14 trading day look back. Let's look at the volume. The volume, this is the median volume, and I have the median volume at about a 20-day look back, and it is descending. However, if you look over here in this chart, you can see that the price is increasing, but the volume is descending, and so is the RSI. That, my friends, is what we call divergence. And whenever divergence happens, it is the anticipation that a reversal is going to happen, whether that reversal is in the RSI or whether that reversal is in the stock market. And when you really think about it, okay, the stock market has basically just gone freaking vertical. It's gone vertical since 2022. All right. And especially since last October, a year ago, it's just got straight up, not even a 45-degree angle, but just straight up. And this can continue happening. I'm not going to say that tomorrow this is all going to change, sell everything, dump everything, and just go straight into puts, whatever. I'm not saying that. I am someone who's more of like, I stay mostly fully invested most of the time, but I do rotate the asset allocation classes that I do invest in. I'll get a little bit more into that later on. But what I'm trying to convey is that if you're in like leaps or short-term calls that you're expecting some sort of run up in the near-term future, the odds are not in your favor, right? That's like flipping heads or tails. Not heads or tails. That's like rolling a die and basically betting that like a 6 is going to come out and putting all your money in there. Like, why would you do that? Because then there's a 5 out of 6% chance, or there's a 5 out of 6 chance that you're going to lose. So why would you put all your money expecting that every other number, but it's that a 6 is going to come out versus every other number? You don't really want to do that. You want to kind of hedge your risk per se. Yo, what's up? What's up? What's up? What's up, Sam? All right. So, anyways, that is where SPY is at. And what do I have here in my notes? Yeah, the volume divergence. So let's go ahead and take a look at actually, I also want to look at the monthly chart on the SPY. So this is actually pretty interesting. So this is a monthly chart on the SPY. Like this is insane. This is insane right now. Like this thing is just straight up since September of 2023 when we had the bond yield rally scare, and then Rick Santoli was on CNBC, and I pointed this out on the Discord, was that Rick Santoli was like saying that the 10 year is going to be at 15%, and that was literally the bottom. Like that was the bottom of the 10-year yield rallying, and it got me a little bit worried today because a lot of you might know or may not know is that I am short TLT through puts. Very small exposure on it, mostly because I'm still have a good amount of tech in my portfolio, and I need to hedge that risk. As a risk manager, I need to hedge the risk of having some assets allocated in software stocks. Software stock is my background. It is something I'm going to hold for a long time. But in terms of that, I am in shares and I'm underweighting it, but I need to hedge that risk that I have in there by being in TLT puts, right? Might not work in my favor, might work in my favor. Who knows? And as far as it's looking overnight, all right, overnight, yields are ripping like a mofo, but at the same time, bond volatility is pretty high up there. So this can just easily reverse tomorrow like it did last night. So again, the SPY monthly is just ripping up into the right. The RSI on the monthly for SPY is at 87.78. I made a very deep mistake with the China markets. All right. I did pretty good. I made a lot of money in the China markets in leaps on KWeb. And then I took my profits, which was great. And then I went pretty damn hard in shares in KBA, which was very bad timing because everything pulled back pretty heavily right after that. And one thing that I didn't really take into account was the fact that, hold on, let me just go back to the screen here, was the fact that China was moved very quickly, moved 30-40% in a matter of a few weeks. And it was due for a pullback. And the expectations were very high coming into a lot of stimulus meetings for China. And I went ahead and bought a position in it. I made a mistake. All right. It happens to all of us. Luckily, like Stanley Druckenmiller, I didn't lose $1 billion in a few hours. But I'm not going to lie, I lost a pretty good amount of money. And it happens. You know, it happens. But I don't want to make that mistake again when I go heavy in a position. And I'm certainly not going to make that mistake now. And I could be wrong. But at the same time, if the market continues to propel upward, then I'm still long a fair good amount of U.S. equities and tech center positions. So I'm cool if it continues going up, and I'm cool either way, to be honest. Like, I can't predict this shit. So anyway, SPY is at 87.78. Now let's take a look at the Qs, the NASDAQ ETF. On the monthly, this is at 82.51, up and to the right since a year ago. Not saying it's going to drop. I'm just saying that the odds are not in my favor to be leveraged long on tech right now. And I'm not. Looking at the weekly, it's not as bad, but it's still pretty up there. It's at 70. And again, we have the volume divergence over here. And actually the same thing in the monthly too. The volume is decreasing as the chart continues to go up. That is another divergence, not so much in the RSI, but the RSI is pretty elevated. So it does kind of give that less risk reward. On the weekly for the Qs, the divergence is pretty there with volume and RSI decreasing, but yet the chart continues to go up. And you've seen it countless every single day. The NQ, the NASDAQ futures, sells off overnight, opens up in red, comes out green. It happens every fucking day. And I'm not saying that it's going to drop anytime soon, but all I'm saying is that the volume is not showing up during the cash session. All right. During the market session, it is not showing up. The inflows do not show up during the session. It ends up flat. So what does that say? That literally says to me that the market is selling off bonds. It is bearish on yields, and it is not bullish on equities. But that can literally change when earnings season comes up. Earnings season come up and just smack me in the face and rip my face off. But go ahead and rip my face off, all right? Rip my face off because I'm still long equities. I'm still cool with that. I can deal with that. I can deal with that pain because that ain't pain for me. That's gain. No pain, no gain, but it's still gain. So I'm still cool with that. I'll still deal with that, all right? So the next thing I want to look at, IWM. Now, is there an opportunity in IWM? I don't know. You know, the problem is that IWM has a lot of non-profitable businesses in it. But as an ETF, we did not make all-time highs in IWM since 2021. All right. 2021, the top in IWF on a closing basis, the top was 241.81. We are at 221.26. How many fake outs have we gotten in IWM? This is freaking insane. It's like we rip up, we come down, we rip up, come down, rip up, come down. But these are a bunch of higher highs. Sorry, higher lows over here, but a lower high over here. So if we can take out and close above this recent high that we had, which is technically still a higher high, we could potentially see the market continue to rally. But that does not mean it's going to happen. And it also does not mean it's going to drop. Am I hedged? Yes, I am hedged. But am I hedged a lot? Not at all. I'll make money if it goes down quickly. But if it goes up, I won't really lose that much money because I'm still long a good amount of stocks. So next chart I want to look at is SOX. So this is actually a pretty interesting chart over here. Okay, because what was really the leader in this whole bull market since 2022? What came out in 2022, specifically in November, December of 2022? What came out that shocked the whole markets? ChatGPT. Now, I'm not going to say that hasn't been out for a while because honestly, it's been out. ChatGPT has had previous iterations, but ChatGPT 3 came out, and that was the one that kind of blew everyone away. That was when their daily active user went through the roof. Everyone started using it, subscribing, and that was when companies and CIOs started getting hit and started using applications that could gear toward AI and utilizing these LLMs for their internal technology. That was when it all started. And since then, it's just been a ripperoo, right? If we look at this SOX chart, like this is the most monster. Actually, you know what? Let me look at the percent. All right. So since I'm going to go all the way back here, and I'm going to start specifically at 2022. So since 2022, the SOX ETF is up over 100%. An ETF. Not a stock, an ETF that's made up of obviously the majority is made up of AVGO or Broadcom, TSM, Taiwan Semiconductor, NVIDIA, AMD, ASML, and all those holdings. But what are we seeing right now recently? What are we seeing right now in the SOX ETF? It is not making a higher high. And what is making all-time highs? QQQ, SPY, all right? What is not making all-time highs? SOX, okay? What is SOX comprised of? SOX is comprised mostly of ASML, all right? It is mostly comprised of TSM, Taiwan Semiconductor. It is mostly comprised of NVIDIA, AMD, Broadcom, all right? Let's take a look at those charts real quick. Is AMD at all-time highs? Whoops, that is definitely not AMD. Is AMD at all-time highs? No, it is certainly not at all-time highs. Is TSM at all-time highs? Yes, it is. TSM is at all-time highs. It just reached an all-time high. Is AVGO at all-time highs? It's like right there. It just made an all-time high the other week. All right. Is NVIDIA all-time highs? I mean, I don't need to pull this freaking chart. NVIDIA is just up and to the right. All right. So on the surface, we see that the major companies in the SOX index are pretty much near all-time highs. But what are we looking at under the surface? All right. This is my list of a lot of semiconductors. All right. We have AMET in the same sector as ASML, not even near all-time highs. We have ASML. A lot of you guys already know the stock, not even near all-time highs. A lot of people are buying the stock thinking it's a good dip to buy. I personally don't think it's a good dip to buy. I mean, you have more than a few things over here, but ASML, I think the problem that they ran into actually was more of a company problem than an actual semiconductor problem. And semiconductors continue to rally. Like I'm still bullish on semiconductors. They can, but in the near term, maybe not so much. All right. Broadcom making all-time highs, like I showed you. Micron, it looked like it was going to make an all-time high, and I actually was bullish on Micron for a minute when it made the swing low over here, and I had calls, and then I sold them right after the earnings and got out. All right, a few guys were on me in that one, talked about in the Patreon. LRCX, which is another chip manufacturer, supplier, and it is not even near all-time highs. Could be a bounce, right? But you have like small ones over here, like Marvel, near 52-week highs. Pure Storage pulled back quite a good amount. We had that QCOM news that just came up recently with ARM, where Qualcomm is no longer going to be in ties with ARM for some of ARM's chips and stuff. Like that's pretty bad news. And ARM is down like 10% overnight. Like not really good news. I mean, it might recover. Dell was actually a pretty good one. This is a direct play for data center whenever it comes to semiconductors and data center build out. They are not near all-time highs. I was actually pretty bullish just for a minute, but I got stopped out in this trade when I was in the high 120s, which is cool. I'll take my gains, get out. That's the point of stops. But at the same time, I look over this and I'm just like, you know what? This chart does not look good at all. It looked like it was going to do. Maybe it's going to swing low and then continue rallying. It still looks pretty bullish to me, to be honest. But if we break this support line like right here around the 104, it's going to go down. We previously had a swing low around the 115s over here. If we break this one, 114s, 115s, it might go down pretty lower. But at the same time, one thing you got to make sure is that is your thesis still intact? Are you long-term, short-term? Are you going to retire soon? Do you need this money? You don't need this money? We can't really answer that for you. That's a decision you need to make on your own. But for me, I'm not so bullish on certain semiconductor stocks right now. If I was bullish one, it would be NVIDIA, Broadcom, or TSM, right? That's one. But TSM is nearing its point where it's pretty close to testing its breakout point, where it had its recent earnings. To be specific, there's this huge gap over here between 187 all the way up to where close to 198. So it's like a 10-point gap. So what is that? That's like 5-6%. It could fill this gap. It could not. Like there's like a billion gaps over here, right? This is a stock. But when you look at the ETF, though, ETF doesn't look so hot right now. Okay, so it's really up to you guys where you want to be in that one. I got a few more macro marks to go through, but I kind of don't want to go over all of it. One major thing that I want to go through over here, and I know, see, this is the thing, and someone Flat Market pointed this out to me on the Discord earlier today, and he was just like, why are you guys like everywhere during your podcast? Can you guys like stick on one fucking topic? Well, I'm sorry, man. There's so much to talk about, and we can't get it all to you guys in one freaking hour, but we have to. You're right. We have to stay structured. And I'm trying to stay structured in this one. And I was a little ambitious with how many stocks I'm going to go over in the deep dive. But I mean, I'll try to go over what I can. You know what? To be honest, it's like freaking 11 o'clock at night over here in the West Coast. So if I got to go for 2 hours, I'll go for fucking 2 hours. You know what? If Matt Money can go for 2 hours, I can go for fucking 2 hours. Like that guy's a fucking G. Follow that guy on Twitter. Follow that guy on YouTube. Do it. All right. And this is what I'm going to do. I'm going to do me. He's going to do him. That guy's fucking killing it. I'm jealous as fuck. All right, so here we go. Let's see here. Sorry for that little rampage, fellas and ladies. All right, here we go. So this is the Bitcoin and M2 global money supply. Now, which economy is stimulating the F out of its economy? Is that the correct way to say it? I don't know. Is that the correct way to say it? Like, fine. All right. China. All right. China is pumping the F out of its markets. Not only China, Europe is doing it too. And the great nation of the United States of America is doing it as well. And which asset is heavily correlated with money supply, liquidity, everything? crypto. Okay. I am uber bullish on crypto right now. Like it is just like, I don't know, man. If we go back to October 2023, when crypto was like 25K, 32K, back and forth, back and forth, back and forth. It broke out of that shit right before the market bottomed. And that was almost a year ago today. Where are we today? We are in a range, a much bigger range, but we are in a range between 52K to 57K up until the all-time high 74K. We are probably going to break out. And the reason why I say we're probably going to break out is because the market is pricing in a Trump presidency like a freaking landslide. And Trump is like a crypto pumper. He has a coin under his own company. Like he is a pumper of crypto. And if the market thinks he's going to be president, which they do, there's like a 60 to 40 odds or 55-45 odds. And if they think he's going to be president, they're going to pump the F out of crypto. But I don't think it freaking matters whether he becomes president or not. Because the thing is that all of these central banks are pumping liquidity into the system. And if they are doing that, they are increasing the global money supply. One of the only countries that is increasing rates is Japan. And is Japan increasing rates? No, they're not. They stopped. They're waiting to get the green light. And it's not like they don't want to increase it. They want to freaking increase it. The Japanese, what is it? The Bank of Japan, they want to increase rates, but they can't because I'm pretty sure either Powell or someone gave the BOJ governor a call and was like, you better not increase rates, mofo. You increase rates, you're going to destroy the entire system. And like, I'm pretty sure he didn't have to get a call. He was probably like, yeah, I can't do this shit. Like, I can't increase rates. And that was like extremely bullish since August 5th, right? But he wants to increase rates. Now, it doesn't matter if he increased rates or not. Almost every single country in the entire world is cutting rates. And that is putting more liquidity into the system. Crypto, as you can see on this chart, is very well correlated with global money supply. And where is global money supply headed? Global money supply is headed upward and it is not stopping. All right. So if there was one asset class that I am long crypto. I'm long Solana. I'm long Ethereum. I was long Bitcoin, but I switched to Ethereum because I think altcoin is going to have an alt season. And I have short-term calls in crypto, and that's fine. They go to zero, the price will go to zero, but it's more of a degenerate bet, but that's fine. But long-term wise, I've been in crypto for the most part since 30K, and I'm not selling my core holding, and that is Solana. I'm very bullish on Solana. Don't really ask me about the fundamentals about it. To be completely honest, this is like, I don't know, 2% of my portfolio. So I'm not going to really get into the nitty gritty about the fundamentals about it. But at the same time, I see this correlation. It's improving over and over again. There are so many freaking bulls in crypto. Like and already all these ETFs are coming out. Fund managers talking about 1%, 2% allocation of crypto, set it and forget it. I'm going to set it and forget it. I'm just with that crowd, right? So that, my friends, is the macro outlook. I spent way too much time on that. And you know what? We're just going to have to deal with it. And now we are going to get into Grab Holdings. All right. What is Grab Holdings? I don't know. What is Grab Holdings? Next segment, we're going to talk about that. No, just kidding around. All right. So Grab Holdings, let's bring up a little bit of a presentation here from their recent Q2 fiscal year 2024 earnings. And we got Grab Holdings, all right? Grab Holdings. Now, to kind of get the gist of it, all right? Grab Holdings is basically the Uber of Southeast Asia, all right? You have Uber in the US. They do taxis, they do food delivery. They aren't into the financial segment, but that is completely saturated in the US. So I wouldn't really say that it would be a very good place for them to get into. They do want to get into travel and so on. Basically, mobility, people move or whatever that is. In Southeast Asia, they, for the most part, didn't really centralize all of this mobility and taxis. It was mostly like, just people opening, like people buying like a jeepney in the Philippines, or, jeepney. I think they have jeepneys in other countries and stuff, but for the most part, like it wasn't really like a centralized service that we did have in the US, where you have like 2 or 3 cab companies that run the entire show. In Asia, it's like a freaking free for all, right? And then food delivery, like that, just unheard of out there at the time. Like more than a few years ago, it was unheard of. But probably, I think it started. Anthony Tan probably started, I think, like 3, 4, 5, 6 years ago. He was pretty ambitious in starting a company that would be mostly focused on mobility, so kind of like taxi service. He understood, and he actually does do a little bit of taxi drives himself, or grab mobility rides himself. But at the same time, he understood, one, that it was a market that had a lot of opportunity, but two, the safety in it was very tough, because a lot of these taxi drivers get robbed. Like, they're carrying cash around with them. This isn't like in the US, where like there's cops at every corner. This is in Asia, where like someone could just get mugged, and like, what are you going to do about it? You can't do anything about it. Like, you're never going to see the person again. There's no fingerprinting. There's no identity theft or any of that stuff. And there was a lot of opportunity out there. So this Harvard graduate was raised by a dad who really ran like one of the largest manufacturer suppliers for automobiles in Southeast Asia. So it's not like he was like someone who just like, was a college dropout, didn't know what he was going to do with his life. All of a sudden, started, like this guy, he's a Harvard graduate, which for one thing is the Ivy League in the US, which if a lot of people don't know. But a lot of the current CEOs and businessmen that you see in the US, they are Harvard graduates, part of that business school. And this guy has a very deep background working for his dad for a little bit. And then he comes out with this idea that he actually co-founded the company with one of his classmates, and they started this company. It wasn't originally called Grab Holdings. I can't remember the company off the top of my head, but they started a small company, ran it outside of a small office, and it was literally done like on paper. Like, they didn't have any mobility apps or anything like that. It was done on paper. They just had like a little bit of a taxi service in Southeast Asia. And it went pretty well. And then they partnered with some third outsourcing company that built an app for them, and they were able to expand very quickly. And then they expanded elsewhere to other regions. And the good part was that they don't have that many competitors out there. And not only do they expand outside of Singapore, but they expand to other countries like Malaysia, Philippines, I believe Vietnam as well, Thailand, and a few other countries, mostly like the emerging markets area. And the thesis that I come to this is that, one, they have the optionality in their business. Now, let me get into a little bit of the details over here. This is their financials. All right, so top level, I actually want to get down to what their businesses are, so I kind of explain that a little bit. And okay, so they have the mobility segment, which is like basically Uber of Southeast Asia. I'm gonna get a little bit into how Uber actually does play a role in this market. But mobility is basically taxi cab service, right? Riding on demand. They have an app. People request a ride, they get a ride, and so on. And they don't pay them with cash or anything. They pay through the app, which is great. They have the delivery segment, which is based like Uber Eats or Grubhub or so on, but it's in Southeast Asia and it's doing very well. They recently opened a little bit more than a year ago, the financial services segment, which is based, they're loaning out money, and they grew their book to like about, what was it? 400 million in less than a couple of years. That's growing very quickly. Right now, they are not profitable in this segment, but hopefully they will be soon. They are definitely profitable in their mobility segment, and they are profitable. And this is on just as EBITDA basis, but as a company as a whole, they are adjusted EBITDA positive for the year so far, but they're hoping to be adjusted free cash flow positive this year. And I'm expecting that to actually happen in Q3 or Q4. one thing I wanted to look at, I talk about the optionality, the different businesses, and their dominance in the markets. They do dominate the majority of the markets in Southeast Asia. But one thing I wanted to get into was okay. So the Q2 financial highlights was that there was 17% growth year over year, and now this is coming from like triple digit growth for quite some time, but they are down to 17%. And actually, last quarter, the market did not like the fact that the growth was shrinking very quickly. But one thing you got to remember when it comes to emerging markets is that the US dollar plays a significant role when it comes to the earnings for these companies when they report in when they report in US currency. So what you got to look at when it comes to these companies is the constant currency. You're gonna, if you don't really invest in emerging markets or in foreign markets in general, you need to look at the constant currency. And a lot of these mega cap stocks, they really report in constant currency because they have a lot of clients that are around the entire world. And it all really needs to be centralized into one type of currency and a constant currencies because currencies go up and down every single day. And depending on which market or which country you're working with, like it could be volatile AF, right? So even when it comes to emerging markets, these can be very volatile sectors in terms of their currency. So if we're reporting on a constant currency basis, we're keeping currency static, they're 23% year over year, which is pretty damn good. Their gross on demand merchant value, or GMV, which is a very it's a very important metric when you talk about e-commerce, when you talk about services overseas, and when you talk about basically the services industry, the gross merchandise value is 18% growth year over year, but the market saw the 13%, and then they just dumped the stock. They adjusted free cash flow turned positive for 36 million on the quarter. I don't believe that's positive for the whole year. So we'll see how that turns out in Q3 and Q4. And I mean, overall, the company's doing pretty good, right? Their monthly their monthly active users is increasing year over year. They have a lot of optionality with different segments they can grow in. I mean, you know, if you look at the mobility segment, they have Grab Car Saver, they have Grab Bike, they have Grab Share, they have Grab Car. Like this is the Uber of Southeast Asia. So one thing I kind of want to go into a little bit was why is Uber in the mix over here? So there's actually this segment. They did an interview with Anthony Tan, who's the CEO and founder of Grab, and he did talk about a little bit of. Hold on, let me actually share this tab for you guys, and I'll play it for you.
Far from easy. The company has faced strong competition along the way, including from the likes of US-based ride-hailing giant Uber.
If you looked at those odds, it looked like we would get crushed by them. And I told Dara when I first met him, I respect you and I respect the company, but iron sharpened iron, you guys pushed us real hard, and we pushed back real hard.
In 2018, Uber agreed to sell its Southeast Asia business to Grab in exchange for a 27.5% stake in the company. As part of the deal, Uber's CEO joined Grab's board of directors.
It was a tear-shed moment for all Grabbers. It was going to be announced at 10 a.m. We didn't even know the deal was going to happen at 6 a.m. We were still negotiating till like 2 hours before the press announcement. I remember when it signed and the deal got closed, many of us in the meeting room like literally fell to our knees. We were just like, I can't believe this is happening moment.
This deal established Grab's dominance in the region, a dominance it still holds today.
It's been all about this ecosystem mindset. That's what differentiates us, right? Understanding what is their problem. If you look at when we first started, it was to solve the safety problem.
Okay, so he gets a little bit into the company during this interview. It was a really good interview that he had. Really helped with my thesis. Also, gets a little bit emotional when he starts talking about his dad. Anyways, I'll put the link to that in the chat. All right, so very bullish in this company long term. I had more notes over here. Okay, cool. So MTU, page 10. Okay, so over here on page 10, let me just make sure I'm sharing the screen. Nope. wrong one. Here we go. Okay, so over here, this is where they kind of talk a little bit more of their loan book. As of last quarter, their bank deposits around 730 million. That's a lot. All right. When you look at where they were 3 years ago, or 2 years ago, they were at no, actually, I'm sorry. When you look at bank deposits, I think this is actually on this chart. I was actually looking at a different chart when I was looking at this. But when you look at Q1 2023, they were at 36 million, and now they're at 730 million. Loan dispersals grew 43% year-over-year with an annualized run rate of 2 billion. So this is a very quickly expanding sector. One thing you got to remember is that there's a lot of risk with this. And you need to understand that when you're talking about loans, non-performing loans becomes an important metric. And I don't think they report it directly on this presentation, but I need to continue looking further into this. But there is a risk when it comes to that. If you have a large amount of non-performing loans with the majority of your loans, that means that they are at risk at defaulting on some of these loans if they don't pay up. However, that metric is not provided here. But at the same time, this is not the thesis for me owning this business. The thesis is the optionality, their moat, as well as their dominance in pretty much Southeast Asia when it comes to delivery and mobility. This is just a little bit of icing on top of the cake. So that's right. All right. So page 13, I have over here another important metric. A lot of people love to look at this too. Their Q2 2024 unaudited results, net cash liquidity. So as of June 30, 2024, they have $2.5 billion in cash and cash equivalents on their balance sheet. All right. You add other long-term investments, time deposits, cash investments, they have $5.6 billion on their balance sheet, and they have $300 million in loan and borrowing. So then that means they have $5.3 billion of net cash on the balance sheet. All right. Today, this company has a market cap of 16 billion, right? And this is after their rapid rise in share count. Now, let me be clear. All right. Let me be clear. Do I think this stock is going to run to like $5 or $6? I don't know. I'm not banking on that. All right. Like this stock has ran like 25% in like the last month. Right. So when a stock makes moves like that, it's a pretty good chance that it's not going to continue its run up unless the macro still stays positive. But which macro are we talking about? Are we talking about US equities, or are we talking about emerging markets? Emerging markets are going to vastly outperform US markets, in my opinion, in the next year or two, right? So can it still run up? It probably could, but know the risks, right? It already ran up 25%. Let's look at the 1 month. Okay, fine. I'm sorry. 14% in the last 1 month. Like that's a big gain. Like this ain't no rocket lab. This isn't a US stock where people can buy it. They can look up other. There's a lot of factors in this. This is not a safe bet. Know what you're getting into. But at the same time, you see $5.3 billion on its balance sheet. And then you see a market cap of $16 billion. That's like not even 11. That's about $11 billion enterprise value, because enterprise value is calculated with market cap minus net cash holdings. So $11 billion. And then let me share this screen so you guys can see it. They provided their outlook for 2024 revenue, 2.7 to 2.75. So that means that, let's just say it's about 2.75. That means they're trading at about EV sales. They're trading at about 4 times EV to sales. All right. And Uber trades at around 4 times, right? So if I look up Uber over here and look at the valuation, EVs to sales 4, they're about 4 times. But Uber is in the US. So, they're going to have that additional premium because they're in the US. And I know Sam is going to probably argue with me on this one. Okay. Like I am bullish Uber, like don't get me wrong, but I think there's much more upside when it comes to Grab holdings, mostly because they're in emerging markets. And yeah, you're agreeing with yourself. I mean, you're in Poland. I don't know if that's an emerging market, but it's definitely not US markets. And I'm definitely bullish non-US markets right now. I think there's a lot of potential. I also think there's a lot of potential with Uber, but when we're talking about the trajectory in terms of a company and where it can end up probably 2 or 3 years from now, Uber is not going to make a 2 or 3 bagger in the next 2 or 3 years. Grab has the possibility of doing that, but it does have a lot of risk. Is Poland an urban emerging market? Yeah, actually, you might be right. Certain parts of Europe are really cool. Yeah, definitely bullish on Grab. I don't want to get too deep into that because we do have a few other stuff to get into. We're already 50 minutes in. Jesus, I always like playing this stuff out, and I think like maybe I have time for this, and I list like 5 or 6 things in the timeline, thinking like, oh, gotta get through all this, and like I'm not even fucking close. Like I'm only on like the second segment. Grab holdings, second segment. All right. Bullish on Grab. Actually, there was one more thing I wanted to take a look at. I want to take a look at the chart. Okay, so Grab holdings chart. All right, this is freaking insane. Okay, if I zoom over here and I look from like 1 year back, like this is freaking insane. All right, does this look like something you want to buy calls on? Probably not. All right, you zoom back though, 5 years. Okay, now we're talking. All right, now we're talking. Handed though, this is a SPAC. Yeah, SPACs. They don't really have a good name for itself, but apparently they do now because we're in a different era. And this thing was very overvalued when it opened. I saw it, didn't really glance at it back in 2021, right? Whatever. I look at it recently. Okay, it's starting to look good. Things starts to go sideways a little bit. I start buying like around the 330s area. I start buying heavy. I start buying calls around here, more calls here. I get screwed over. I'm like thinking, wow, I made the stupidest mistake of my life. Thing rips today. Great. All right. So it personally, I have leaps on it. They expire in 2026, some in 2025. And it was actually a small position, not so small anymore in terms of leaps because the thing ran up so big. Am I going to hold it? I don't know yet. Earnings are coming up in a couple weeks. We'll see what happens. Why is the stock rallying? I don't fucking know. I don't know. I don't know. The market does what it does. And the only announcement that I've seen recently since Friday was that they announced their earnings are going to come out. They actually announced this yesterday. They're going to release earnings soon. And I don't know how that's bullish. Why is that fucking bullish? I don't know. The only answer that I could come in was someone knows something. Someone knows that earnings are going to be really good. People are sniffing the shit out, so they're trying to buy it up. And then you got a lot of call buying. Why the leap so cheap? Someone asked this earlier. Who asked it earlier? Can you explain why the leap is so cheap? Well, the volatility on the stock. So what they got to remember, ETF, is that options are priced based on the 5 Greeks and IV, right? Or the 4 or 5 Greeks, I forgot, and IV, all right? So if the implied volatility of a stock, like this thing has been trading sideways for the good part of 2 or 3 years, right? So why would the options market price a huge move in the near term? It wouldn't. It wouldn't price that big of a move in the near term. The IV would be low. What is the IV today? I think it was like 65%. I forget. How much of the options now? Well, they're probably a little bit inflated now. But why are they so cheap? Because of the fact that they're moving sideways. Also, it's a $4 stock. So why would you have to price it expensive? Right? Like this isn't like a Palantir or Rocket Lab where the IV is so big because it's moved a lot recently. This is a $4 stock that's been moving sideways for 2 or 3 years. So hit me up if this price is like $10 in a couple of years where it's moving like 2 or 3% every single day. Hit me up then. The options are not going to be cheap. They probably won't be cheap. So that is the play that I'm going for this with the options. Near-term volatility, increase IV, and on top of that, increase appreciation in the stock, increase value of the options. That is when I sell against the calls that I have. Right now, they're naked. Small position. The shares, though, not so much small. I actually sold my booking holdings position and I put into grab. Good play. Totally lucky. Very risky move, but I mean, that's my prerogative, whatever. Anyways, that is it for grab. You're welcome. You're welcome. You're welcome, ET phone home. Next one is TransMedics. What is the deal with TransMedics? What the hell is TransMedics? Well, thank you for asking. Let me open up some documentation that I have in TransMedics. Okay, sorry, some messaged me or something. All right, so let's go ahead and go to the TransMedics investor presentation. Probably the easiest way I can go over this one. Cool, that's not the TransMedics one. Great. All right, hold on. I got to share the right screen. There we go. Okay, here we go. TransMedics, transforming organ transplantation therapy worldwide. Okay, so what does TransMedics do? TransMedics develops technology or develops equipment for transplanting organs, right? What was the old way of transporting organs? Take a heart, put it in a casing with ice, point A, point B, here you go, in your body, done, right? That was, as stupid as that sounds, that is how they've been doing it for decades, right? So what is, okay, fine, maybe I'm exaggerating, but what does TransMedics do? TransMedics comes out with this advanced FDA-approved multi-organ technology platform, this device where you put the organ in here, and the organ is literally living in this system, in this enclosure for a period of time. And, you know, there's a little bit more they do with the organ. Obviously, they don't just throw it in there and be like, hey, can you just like stay alive for a few hours till I move you point? No, that's not how it goes, right? But they with some drugs that they inject into the organs and so on, it is able to keep the organ alive for a prolonged period of time to deliver to the transplant center, right? That is what they do. That is their biggest business that they've been doing for a while, right? And it's been doing great. However, recently they decided they do not just want to create and sell this device to transplant companies. They want to control the end-to-end OCS or organ care system technology in the US from the donor center straight to the transplant center. Now, what does that involve? That involves the transportation and logistics, the surgical retrieval, the OCS technology, organ care system, the OCS clinical expert or the organ care system clinical expert, the doctors, the surgeons, and so on, straight to the transplant center. They want to get the call that someone says, hey, I got a heart. I want to donate to someone right now. Are you ready? Well, TransMedics says like, oh, I'm ready. Bring it. I got the planes. I got the surgical retriever. I got the technology. I got the experts. I can take care of you. Let's go. TransMedics is available 365, 24/7, 24/7, all the time. It has pilots on call. It has planes ready to go, man. It is everything ready to go. It has its whole system. TransMedics wants to take over this freaking market, and they are doing it hand over fist. They are growing. They are expanding different hubs around the entire country. Not all of these exist today, but this is what the coverage that they want to expand to. They are growing rapidly. The amount of volume they've grown since calendar year 2022 to 2023 from 1,000 to 2,300, 130% growth in one calendar year. From 2022 to 2023. It is continuing to grow. The national volume growth for just heart and liver, they do heart, liver, and lungs, all right? But the highest demand right now is kidney, which they don't service, and then it's liver. And the heart, of course, is very up there, but in terms of the servicing demand they're able to get to, it is liver and kidney. So liver is the number one that they want to penetrate, which isn't their isn't their biggest revenue. The biggest revenue they get is from heart. And it isn't exactly easy to expand on the heart because the amount of donors for hearts is not nearly as much for liver. So they want to be able to take over that segment, and they are growing it. Look at liver. So the amount of volume growth they've had from liver in 2022 to 2023 is 12%. For heart, it's 12% also, but it's a much smaller number. So you can see here the potential for liver is a lot more than heart because heart has a lot of demand, but not so many donors. So, you gotta remember that. So now, one thing you gotta remember is that with this new device that they have, this new technology that they have, it isn't something they can just like put out there. It's like everyone just go ahead and use it. Like it's got to go through clinical trials, it's got to get FDA approved and so on, which they already do have the FDA approval for all of their devices, as well as all the clinical trials. And they're continuing to do it to make sure that their tests are coming out positive. But it has reduced the amount of severe PGD, which is basically like failure. So like, let's say in the old method, someone took someone's heart, put it in ice, delivered it from patient A to patient B, and then the heart was just like dead on arrival, which happens, unfortunately happens, or maybe the heart is incompatible, whatever, so on. That TransMedics was able to reduce that rate by 50%, or it was a 50% reduction in the nominal value, which is severe PGD over time, right? So in January 2023, it was a case of 197, and it was a case of 93. So this is like, what they got to remember is that these are numbers that they provide to you. So you can't, this is an investor day presentation. They're trying to sell their company to shareholders, right? So you got to kind of take it with a grain of salt. You need to be able to compare these metrics against other companies and competitors, as well as data that's available on a public basis, right? So if I go back to this, let's just take it at face value, right? This is their investor presentation. This is just trying to sell their product, right? I'm just trying to explain to you what TransMedics does. All right. And like I said before, they own the planes, they own the pilots. They can really just deliver this stuff like overnight if they really have to, right? That's a benefit of owning the aviation company that they recently acquired called Summit Aviation. And they're actually continuing to purchase more jets and train more pilots and so on. That's actually one of their near-term goals is to expand their logistics. And their long-term goals is to basically create this next generation OCS, or organ care system, where it's going to do a lot better in terms of the donor organ failure on arrival, DOA, whatever it's called. They're trying to make it better, right? Like, this company isn't perfect, right? There's a lot of risk when it comes to this company, specifically when it comes to this company, and they actually list it in their 10K. Is that there's potential, and there's been a lot of pushback with politicians, as well as certain I don't want to say fiscal policy, but like, they're dealing with people's lives, right? So there's a lot of politicians that don't have it in their favor to let something like this pass, right? Like, that maybe there's lobbyists in their pockets and so on, and lobbyists might come from major corporations that it is not in their benefit. TransMedics continues to expand and grow, but at the same time, there is that battle. There's that risk when it comes to investing in these companies. The TransMedics is trading at 122 right now, and it can go below 100. It can. I mean, they report earnings soon, so it can. There is risk tied to this stuff. Like, I'm not trying to sell you this saying, buy this hand over fist right now, calls, leaps, whatever. In fact, I only own shares of TransMedics. I don't own leaps or anything, because of the fact that there is inherent risk when you invest in these companies, especially when it comes to health. Like, this company can fail in the next couple of years. The likelihood of it happening is pretty low, but it can happen. So know that risk. So anyways, getting back to this presentation, let me actually take a look at my notes over here. So I talked about the growth. Okay, yeah. So quarterly revenue, I mean, this thing is just up and to the right, and it's accelerating. Like, this isn't, well, not really accelerating, but in terms of the revenue, like the quarterly revenue, this is just going up exponentially. And when you think of the year-over-year growth, it may not be accelerating, but at the same time, it is at a pretty crazy clip. I mean, look at this annual revenue. Fiscal year 2021, 30.3 billion, 2022, 93.5, 2023, 241. Now, is this going to continue forever? Probably not. All right. There's going to be a terminal growth rate, but at the same time, there's a lot of potential. I already went over the growth strategy. Currently, they get most of their revenue in the U.S. Are they going to continue to get their revenue abroad? Maybe. There's a lot more policies that have to pass through the system abroad, but most in the U.S. they are actually trying to they dominate the U.S. right now. And again, a lot of the companies I invest in, like they got to be leaders, right? Like it was very tough to invest in like secondary leaders or secondary market stuff. Like they got to be freaking leaders. Like I don't want to have to worry about picking like the best of the. I want to have the best of the best in that industry, right? And I for one believe that TransMedics has a lot of potential that's not really calculated into the current valuation. Have I harvested organs? No, I haven't. What kind of crazy question is that? Dude, you guys are crazy at night. Like, what's wrong with you guys? Anyways, what is a TAM for organ transplants? Funny you ask. Funny you ask, ETF FaceTime. So let me actually pull up something for you, my friend. I actually share this tweet. All right. Napkin math, right? So am I sharing it? Okay, good. I'm sharing it. So patients on the waiting list by organ. Now, this is actually not released by TransMedics. This is data that's released from another organization. So is it biased? I don't know, maybe, but it's a lot less biased than looking at their investor presentation. So the patients on the waiting list as of March 2024, you have kidney. Like I said, kidney is the most highest demand organ. Why? Well, I mean, people need kidneys, right? Like you have one kidney that fails, you have two, well, you're screwed, right? But a lot of people can like donate a kidney easily, but they're very high in demand. I don't want to get into the whole medical stuff behind that one, but it makes sense that would be the highest in demand. Liver, all right, liver is the second highest in demand, and that's what we're going over at the TransMedics investor presentation, is that they have the most volume deliveries for liver. And then it's heart, and then pancreas and lungs, which is good because TransMedics they actually do deliver organs for heart, liver, and lungs, so it's also something they could tap into. But I did do some math based on these numbers. Also, I googled, did a little bit of research on like how much does it cost for a specific transplant, right? So a heart transplant costs $1.6 million per transplant in the US in 2020. There's 3,700 annually. That comes out to 5.92 billion total cost in heart transplants for that year. And it's probably inflated more. I don't know. Maybe it's more, maybe it's less. Who knows? There's a pretty good chance that it's more. For lungs, $929,000 per lung. Per lung. Everyone has two lungs, but per lung, $929,000. Not cheap. All right. Chances are you're not going to pay for it. Obamacare is paying for it. Your insurance paying for it. Who knows? 2569 in 2021, $2 billion annually. Liver, the second largest in demand when it comes to patient organ delivery waitlist. $874,000 per liver transplant. 9,500. How many livers do you have? You only have one liver. You need one liver to live and only one. 2022, $8.3 billion annually. So that's about $16 billion annually, roughly about 2021, 22-ish. TransMedics gets 25% of the revenue from other services as well. So 75% of the revenue is based on transplants for these three organs, which is a $16 billion TAM. How much did they get last quarter? 359 billion. Let me actually look over here. Hold on. Did I have here? Okay, here it is. Let me share the screen. Excuse me. Sorry, guys. Getting late. But I do want to share this with you guys. I don't give a fuck how long I'm going to stay up for. So here we go. So TransMedics. This is their net revenue and service revenue, right? So net product revenue is organ delivery. Net product revenue is the amount of revenue they get from the actual deliveries. Service revenue is for the end-to-end logistics, as well as selling the machinery and so on. All right. So wait, I think I have that confused actually. So net product revenue is the amount of revenue they get from selling the devices that they created. Service revenue is logistics. All right. So 34 million they got in March 2023, 7.6. Today, they got 42.6 service revenue for the logistics, 71.7 for the product revenue. So one thing you got to remember here is that this growth rate for net product revenue is still pretty up there. It's 68.9%. Yes, it's not like the 136% that it was about a year ago, but at the same time, 68.9% is no joke. Their service revenue is the one that they're really focusing on in terms of the logistics business. That's 325% year over year growth. Mind you, they did acquire Summit Aviation. I think it was this year. It was earlier this year. I forget exactly when. So that some of that is inorganic growth. Well, not necessarily inorganic because Summit Aviation was not delivering the organs, but they did acquire a business. So there's a lot of CapEx in there that isn't necessarily considering the revenue, obviously. But one thing to keep in mind is that this is a very fast growing segment for theirs. And it could have a lot of potential considering that they are pushing a lot of CapEx into it, but there's a lot of potential growth. That's the reason why they're pushing the capital into it. So yes, all right. There's a lot of potential when it comes to this company. But again, I did discuss the risks. Know the risks, do your due diligence, not financial advice, and so on. With that being said, thank you all for continuing to watch us for your 25 participants. And additionally, the more people that might continue watching the show, if you have not, please like this video and subscribe to this video and tune in for future content by turning on the notification bell. Really appreciate you being here. Really awesome. It is 11:45 a.m. on the West Coast. I am tired AF, but I am going to keep the show going. Let's freaking go. All right. So next on the list, we have Aspen Aerogel. Now, this is a pretty interesting one. The reason why I say it's pretty interesting is because I just started buying the stock around the levels it's at right now. The mofo pulled back like 33% from its all-time highs. And literally like the day that I started buying, which was yesterday, they announced a shelf offering. So I was like, wow, very shitty timing. What is the shelf? What is the shelf offer? What is Aspen Aerogel? Well, funny you ask, guys, because I'm about to share this investor slide right now. Aspen Aerogel, blah, 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 blah. You guys want to learn more, do your due diligence, but I'll explain to you. It is 3 separate businesses, all right? Its main business, which actually has not been the main driver of its business until very recently, all right? Because before this, they were not focused on thermal barrier for EVs and EV batteries. They were focused on other sectors of the business, which is definitely not this one. And they've actually been public for quite some time. But it wasn't until very recently that they were able to leverage this product for thermal barrier for a lot of major manufacturers around the entire world, namely GM, and was able to grow revenue insane. So much that they were provisioning, or let's just say refactoring an existing plant that's located, I think, in Massachusetts, somewhere in New England, for thermal barrier versus I forgot the name of the other type of product, but the other product is used for LNG, and they're actually outsourcing that to China right now. But let's take a closer look at thermal barrier. All right, thermal barrier is, for the most part, you have your battery. All right, when you charge this battery, actually, let's go a little bit back. What is the chemistry of when you charge a battery on your phone, right? What are you doing? What you're really doing is that you're taking the stable or the static chemicals that are inside that battery and you're forcing energy into it. And what happens when you inject energy into any element in the entire world? It moves, right? You're giving energy, it moves. When you have a battery, it is all of these chemicals. I don't know the specific elements that are inside of it, but when you inject energy into a battery, it heats it up, and it heats up very rapidly and quickly. And what does it do with that heat? The heat tries to escape. That's just generally what heat does. Like if you blow up a balloon, you're pushing heat into a balloon, it's going to try to escape. And that's what inflates a balloon. The same thing happens with battery. The battery wants to expand as far as physics goes, but that's what this thermal barrier gel comes in, is that that's able to contain the heat and sustain it. So that way it doesn't expand or it doesn't reach outside temperatures for surrounding objects to cause fires or, to basically destroy elements surrounding it. For the most part, this has really been around for a while, but Aspen Aerogel, they took one of their existing products and they were able to apply this to EVs specifically and batteries. And I guess they saw a lot of potential in their use cases for electronic vehicles, and they were able to build a product surrounding that. And they signed up a lot of partnerships, specifically with GM, General Motors, that ironically reported earnings today, very ironically, right? And I mean, what do you know about the demand for EV? The demand is starting to pick up, not as much as it was in 2020, 2021, when the government was pumping money into the system and helicopter money for everyone. But recently, it's not so much Tesla running the entire market anymore. These other companies, including GM, they're expanding and they're doing it pretty well. And like I said before, one of the biggest clients is GM, and that is where the majority of the revenue comes in. So there's a little bit of a risk there when you think about that. If you have the concentration of most of your revenue coming in from like one or two clients, namely Confluent, that's something that I'd owned recently, it becomes quite a good amount of risk, because then your revenue depends on how well this other client does. Now, how well is GM doing? GM is doing really well. I'll go over a little bit in their earnings today, but for the most part, their largest growing segment is thermal barrier. Now, in addition to that, they also have this product called cryogel, which is used for facilitating and surrounding to help the liquefaction of natural gas from its gas state into liquefied state, or LNG. And there's a lot more that has to do with this, but it is also a faster growing segment as well. And I do believe that that LNG will be the next energy demand in terms of the market, following nuclear, which is pretty much, I would say, has found its peak right now. So I think there's a lot of tailwinds for this company. As far as the near term goes, it's not looking so great. Let me actually go over more of this presentation, and I'll explain it as I keep going through. So this page over here pretty much explains its EV demand and how it develops its revenue through EVs. You see a lot of vehicles over here, mostly GM and Equinox, one of GM's best selling models. They do get a lot of revenue from that, as far as facilitating the aerogel that they provided for that one. Its financials are looking pretty good. They did just become profitable this year, and it's looking like they'll continue with profitability. One thing that I'm really taking a close look at is the gross profit margin for its earnings coming up in a couple of weeks. So they do have, the gross margins are expanding, but I do have a feeling that the gross margins might contract a little bit or not expand at the existing rate that they have done in the past halves or the past couple of quarters. So we'll see how it turns out this year. At the same time, I do think 2 or 3 years down the road, this company will be much higher value than it is today, especially in the near term, given its valuation that it has today. Over here in this chart, you can see that the revenue is growing very good. Their net income is, I think this is about $7 million versus $2 million 1 year ago, which is really good. Or was this last quarter? Oh, no, this is its outlook. So its previous outlook was 2 million. They updated it to 7 million. Its previous outlook was 59% for revenue, and they updated it to 63% for 2024. Expects to continue to stay GAAP profitable, and they reduced their CapEx. So this was as of last quarter. Now, one thing to remember, especially with the news that's come out recently, is that they got the approval for the Department of Energy for a good sized loan. And that was great. The stock actually rallied a good amount after that, and then quickly faded right after that. And I've been watching the price action of the stock. Let me actually bring it up here. All right. So over here on Wednesday, October 16, that was when they announced that they had a press release saying that they got approval for the DOE loan, which has been like a big question mark for quite some period of time, supposedly for like over a month before this happened. And as you can see here, it was up. It was up. How much was it up? I think it was up like 20%. So it closed here. Yeah, it was up like 13%, but it actually went as high as like 20%. That's when I saw it that day. And then look at this huge fade over here. Okay. Like this is institutional. Like this is just institutional fading right here. And then today or after hours yesterday, they came out with the shelf offering that they talked about, $85 million. Excuse me. I think it was $2.5 million, 2.5 million shares, and the company's trading about $20. So that was about like $80 to $85 million. Came out with that. The stock market didn't like it. However, one thing I have to admit was that after hours yesterday, it dipped into like the mid 19s. And then when it opened today, it actually opened up nearly flat, came down, and pretty much recovered throughout the day. After hours, it is what it is. Like, I'm not going to try to speculate what happens at this company, like in the very short term, to be honest. Like, I do have leaps on this company as well as shares. But what I'm seeing in this company overall is that their revenue is growing double digits. They are GAAP profitable. Yes, they did do a shelf offering and they did get a loan, so their debt has increased. But at the same time, they're going to try to build a plant in Atlanta, which they've been talking about. And looking at the GM earnings today, which is one of their biggest clients, where the majority of the revenue comes from, GM freaking killed it, right? So let me open up this. Let me open up the GM earnings. Okay, so this is the GM earnings for today. Now I'm going to sift through this. I don't want to go over the whole thing. I'm mostly focused on the EV segment. So over here, GM has listed out their US EVs as a percent of the vehicle industry, right? So this is clearly increasing, right? So Q1, just 2 quarters ago, they were 6.5% in terms of the EVs as a percent of the vehicle industry in the US. Now they're 8.2. In just 2 quarters, they grew almost 2%. GM US EV market share, now not all vehicles, but US EV market share from 6.5% all the way up to 9.8. They are taking market share. Now, I am a Tesla bull, all right? I definitely think Tesla's going to do great in the long term. Are they going to do great in the short term? I don't know, man. Like, I don't know. Like, Tesla is a massive momentum stock right now. Like, it has momentum, but that momentum has been dying. When reality kicks in, like, the market just sells off Tesla. I don't know if they're going to continue to sell out. Like, I hope it goes up, but at the same time, like, I don't really care. Like, I mean, shares and leaps. Like, I don't really care. My leaves expire in 2027. So if it goes down, that's fine. Like, it's fine with me. But when I think of like kind of a hedge to Tesla, Aspen is somewhat what I see as like a little bit of hedge to Tesla as far as the entire EV market growing. I am very bullish. I think EV is a very much a secular trend in the entire world, not just the US. And at the same time, I mean, Aspen isn't just they don't just have GM as a client. Like, they also have Mercedes-Benz, they also have Stellantis, which consists of Jeep, Ram, Fiat, Chrysler, a few other European brands as well. Like, they're not, the risk isn't just tied with GM, it's tied with a lot of clients, and they are expanding their book. Like, I wouldn't be surprised. Like, okay, sure, fine. So they're not able to produce a gel for Teslas because Tesla has a different type of battery that isn't able to use Aspen Aerogels product, right? But at the same time, it's like it's kind of a little bit of a hedge. Like, I'm bullish EV in general, so like, why not go long these other picks and shovels that have to do with EV altogether, in addition to Tesla, right? Because Tesla is diversified. They're not just EVs, but that is pretty much where most of the revenue comes in. So it is a good idea to kind of diversify your risk, right? Yeah. 90% year over year. I mean, not so much, not as far as their guidance goes, but we'll see. As TMDX, we're a big transplant. Oh, nice. Damn. I guess I am that tired. But anyways, the show must go on. I do have a little bit more notes for Aspen. Oh, actually, there was something I wanted to bring up. Hold on one second. Bless me. All right. So I wanted to bring up back the charts for Aspen. Now, let us bring up the moving average. Why does this shit never? Every time I have the moving averages, it always resets. Always resets. I don't know why. All right, so let me do my 200, 150. Cool. All right. So we can see here on the daily, Aspen's at 29 RSI. Doesn't mean it bottom, but just saying on a scale from 0 to 100 with the range of 30 to 70, it's on the low end. All right. It broke all the moving averages on the 200, 150. Broke the 200. It was testing it for a minute and then it broke it. All right. Not exactly bullish. But do I want to buy the stock when it's up here? No. I want to buy this stock when it's down here. I would buy stocks when it's up here, but not this stock. This stock, it's got to have a huge margin of safety for its risk, right? So I will buy it down here. I will buy shares. I will buy the leaps. It's got the higher low. Could make another higher high. We'll see. We'll see. I don't know if it's going to happen now. If the market curls over, this probably won't do so hot. But my shit expires in 2026, so I'm good to go. And my shares, they don't have expiration, so I'm good to go. Good to go. Very bullish EVs. This is more the materials and industrial sector. So is this going to be impacted if tech rolls over? Not so much. Is it be impacted if the market rolls over? Probably. Is it going to outperform? It'll probably outperform tech, to be completely honest, as a sector, not individual stocks, as sectors. I think it'll outperform. So I think this is a pretty good place to allocate some of my money. All right. So that is where I'm at. And the last one I want to look at, just kind of like top level a little bit. And, again, guys, like this isn't, I know I said deep dives, but like these are certainly not deep dives. Hopefully at some point I will release more content. I mean, you guys on Discord already see content that I release in real time. There's obviously a lot more behind the books. But this is something I just want to share with you guys. So C Limited. Now, what is the deal with C Limited? I mean, a lot of you guys probably already know what C Limited is. C Limited is, it's like the Shopify, Mercado Libre of Southeast Asia. Another Southeast Asia. What is something that C Limited and Grab Holdings and China have with each other? They're emerging markets, right? Emerging markets have vastly underperformed U.S. markets for quite some time. I think that shift is happening now, especially with the decrease of the dollar for a long period of time. Also with the risk assets inflated in the U.S., I think money will start to disperse into emerging markets, which is, I think, is where money is heading toward. And I want to position myself for that, right? So C Limited, I know you like C, man. I got you. I know you like this one. Anyways, C Limited has three different segments. They have a gaming segment, they have a financial segment, and they have a merchandise or shopping segment. All right. Now, enough about me saying this from the top of my head, because again, this is more top level. But I want to share with you the recent investor presentation. And keep in mind, guys, like you don't just look up an investor presentation and just be like, this looks good, I'm going to buy it. Like I said previously with TransMedics, when you have an investor presentation or quarterly earnings, they're going to make their shit look so good, right? Like they're going to make their numbers look so good. They're going to show you what looks really good for them. They're going to show you every single reason to continue buying their stock. They want to look good to the investors, right? So take it with a grain of salt. Look at their financials as one layer of the reason why you go bullish a company, right? Look at this as a layer to figure out why you want to buy a company. So honestly, their last quarter was freaking amazing. And I used to own this company when it was like in the 67s. And then I sold it when it went down to the 50s and it dropped to the 30s. And I thought I was like amazing for selling it at the right time. And then it just like ripped my face off. And I'm just like, well, shit, why did I not just hold into the company? I don't know, lesson learned, whatever. So anyways, they got the e-commerce segment that I talked about, basically the Mercado Libre of Southeast Asia, which ironically, they did have a business, which they were trying to expand to Latin America, and then they really cut that back. I know you did, man. I saw you buying that stuff, $38. Congratulations. They really cut that back because they kind of decided, like, why are we going to put all this? Why are they going to put all this capex to invest in a business that's not really showing its return? Let's just give up. This is the reason why I sold C in like the 50s after buying them in the 60s, because of the fact they were stringing themselves thin so much. They were spending so much capex on marketing for the gaming segment, as far as logistics for their Latin American segment. They were really stringing themselves thin. Like their gaming segment was through the roof. And then they were using that money to provide the funding for all these other crazy ventures that they're trying to get into. Like, I don't know what the hell management was doing. But lately, what is management doing? Management has been saying, like, you know what? We are not going to pump this money into marketing anymore. We are going to give up on Latin America and we're going to focus on what's working right now. And what is working right now? E-commerce is freaking killing it in emerging markets. Is it going to continue killing it? Yes, I think it will continue killing it as far as the consumer confidence goes in emerging markets. It is going to continue going through the roof. Financial services, what has Grab Holdings shown? Grab Holdings has shown, as well as other liquidity being pushed to the market in emerging markets, that liquidity is going to expand. Therefore, people will need more money to buy more shit. All right. Digital financial services is going to do well in C Limited. And as you can see from this chart, 39.5% year over year, 7.8% sequentially. Digital entertainment bookings. Now, when you think of bookings, can't look at this as like straight up revenue that they have on their balance sheet. Bookings is, for the most part, contracts that they did book for digital entertainment that could include or not include revenue that is already billed to the client. So, take that with a grain of salt, but it is kind of give a good trajectory on what their revenue will be in the future and how fast it'll grow. It is looking good for this particular segment alone, right? So financial performance, gross profits are expanding for this company. They are net income positive as of second quarter of 2024, last quarter. Are they going to be net income positive next quarter? We will see. I think they're going to continue doing really good. Ironically, this company was not looking hot like a year ago. And in a matter of a year, like they completely turned the ship around. I actually do have a chart that kind of explained that pretty well. Yeah, I mean, just like looking at this stuff is like really good. Their cash position, they have a lot of cash in the balance sheet, which is a great thing to see in terms of safety. Segment breakdown as far as the revenue goes, the revenue for e-commerce is doing really good. Digital service really good as well. Digital entertainment, other services, and so on. Consolidated altogether $3.8 billion. Operating loss was a positive 82.9. So they are EBIT positive, which is great. Adjusted EBITDA, $448 million. Really good news. And they have highlights over here. Another thing, GMV, gross merchandise value, a great way to measure e-commerce for a company as far as services industry goes, doing really good. Continuing to grow year over year, really good news. Their GAAP revenue and take rate. So now this is another thing that you really got to consider when it comes to the take rate. So the gross merchandise value is more of like the top line when you really think of it. That's the amount of money they're getting for selling all of their products alone. The take rate is the amount of money that they make off of the entire GMV. And their take rate is 12.1%. Really good, because not only good for the number, but good because it's expanding. Now, what am I looking at for next quarter? I want to see this number get bigger. If this number gets bigger, like this stock's going to go like 110, 120%, 120. We'll see what happens. Advertising is a big and underrated business. Yeah, I mean, advertising is just underrated for a lot of companies out right now, because like if you think of the amount of digital, the amount of digital exposure that a lot of the emerging markets are getting. Like more people have cell phones, more people have computers and so on. They're ingesting more online content and they're seeing more ads. More ads means more revenue. More revenue means more income because of the higher take rate and so on. Like it is a lot of optionality for a lot of these companies. If you think of emerging markets, like they're probably where the US was at like 4 or 5, maybe even 6 years ago. So that's only going to grow astronomically. Like there's a lot of potential when it comes to emerging markets. And I just want to make that clear for a lot of you guys, right? If you think of US markets, there is potential, but you will not see the same growth as you will emerging markets as you do in US markets. Is there more risk? Way more risk. Is there more money to be made? Yes, there's a lot more money to be made. But be mindful of your own risk. So I don't want to go over a whole lot of this, but I just want to do it top level a little bit. And I wanted to take a look at some metrics that I did pull up, which I, of course, don't have, and that is fine. Tired as fuck right now. So that's really it for C Limited. So, how am I positioned? I've said this more than several times. I have been overweight US tech for probably a couple of years now. And I don't know, is the word aggressively a good word? I'm pretty aggressively rotating out of that. And I'm putting the money in more emerging markets in terms of indices, specific companies. Like obviously, I'm looking for specific companies that are doing very well outside of the U.S. And I'm sure Sam is doing that too. If you guys don't know, Sam Mercier, he's really smart individual, lives in Europe, looks for a lot of foreign opportunities, a lot of US opportunities as well. I mean, the dude is young. He's been doing really well. Hit him up in Discord. You'll see a lot of his chatter on there. But C Limited is one of the companies he's been bullish on. He's been bullish on Uber. He's been bullish on Airbnb. A lot of companies that I haven't even yet mentioned, Mercado Libre and so on. But I would really say that now is kind of the time you really want to look at emerging markets in terms of risk assets. Also, now is probably the time you want to look at energy too. Energy has been underperforming for quite some time, especially with disinflationary forces. But when I say energy, I don't mean just like buying like USO or buying natural gas or anything, but buying like companies that really depend on this, exporting, right? If we get Trump as president, which is looks like the market's pricing him as president, Trump wants to decrease the trade deficit. He wants to export more and import less. Well, maybe not import less, but he wants to export more, certainly. And what's something that the U.S. has a lot of supply of is LNG or natural gas, right? It's very cheap for us to produce. We are one of the countries that can produce natural gas at a very cheap rate. So if we are able to sell that natural gas for a profit outside, then we will continue doing that. We will continue exporting it. And what are some countries that import a lot of natural gas from us? China, a lot of emerging markets countries, Europe, right? Actually, not all of Europe. Actually, not a lot of Europe, now that I think about it, but a lot of emerging markets, Southeast Asia. So, that's pretty important to keep around. So, you got to kind of keep your ear open on more than just like, mega cap stocks if you really want to outperform this market, in my opinion. You got to read pretty much everything. You got to read all the markets, and it's like a never ending game. Like I said at the beginning of this pod, is that like, I got a family, I got 2 kids, I got a full-time job, working and providing some content for you guys. It's not an easy life. But you got to manage your time well, and you got to love what you do. Like I love doing this shit. Like this is great. Like I don't know. I don't know what it is. I just enjoy this shit. I enjoy making money, but it's good to know that why I'm making money in the market or why I'm losing money and so on. Like I would feel better if I knew why I lost money versus like making a stupid decision and like losing money, which is not really new to me. It's happened many times to me. So yeah, that's kind of where I'm positioning myself in terms of the stock market and future outlook. Honestly, I went over it in the beginning of the macro outlook at the beginning of the pod, and market's very overvalued. The PE is pretty high on a rolling 30-day basis, and I would say the PE is like around 26, 27 for the S&P 500, the Mag 7, And historically, that it trades like around 19 or 20. And being that we're all the way up there and so far extended off the 200-day moving average for the S&P 500, I do think it's time for a pullback. I'm not expecting it to like drop down to the 200-day moving average, but I can see on the charts, I can see on the inflows that things are slowing down as far as inflows goes. Fundamentally, though, the market's getting very optimistic as far as a presidency goes for Trump as a landslide. I think they're pricing it in ahead of time. And when you're pricing it ahead of time, when the actual event comes out, sometimes you get a sell the news. And it doesn't have to be like a major drop or anything, but I wouldn't expect the market to be another 40% 1 year from now. But we'll see. We'll see. Not anything I would go like full cash in, but something to be aware of, for the most part. But yeah, guys, hope you guys enjoy this. Holy shit, I went for an hour and 40 minutes. That is a long freaking time. Hope you guys enjoyed it. It was good talking to you guys. Peace.